Hello, everyone, and welcome back to the new Blueprint Strategy course. Today, I have an exciting lesson planned because today is where the rubber meets the road. So, welcome to Lesson 4, Supply and Demand 101. We figured out quite a lot already, didn't we? We talked extensively about technicals versus fundamentals, with technicals forming our preferred market timing strategies and with fundamentals forming our preferred market setup strategies or forecasting strategies, if you will. And in the last lesson, I gave you a glimpse into the COT, the Commitment of Traders Net report. And I found it quite fascinating to see that all the areas that you guys picked, without exception, led to multi-week bull markets or rallies in gold. The areas that you picked, they all had one thing in common. They all showed a relative extremes in the buying activity of the commercials. And the commercials are what we call smart money. And we know and we saw that they really do drive price. So the learning was that commercials are most important to us when they are at an extreme reading relative to historic buying and selling activities. So the focus here is really on a relative. It is all about the right context. So with that, we can then predict major rallies, and you could predict major rallies and declines in the marketplace. The second learning was that we could predict major rallies without looking at price. We didn't even look at price once. And this is where I believe most people go wrong. They predict price by looking at price. And hold on a second. We don't do that, right? We look at fundamentals to predict price because fundamentals drive price. But where does this leave price, or what do we need price for really? That's the thing that's left to figure out conceptually, is how to get in and out of the markets when we see a good fundamental setup in the marketplace. This is where technicals, the analysis of price, will come into play. So supply and demand will help us in identifying where, in terms of price, those institutions are most likely to buy or sell. So let me repeat that. Supply and demand will help us in identifying where, in terms of price, institutions may be willing buyers and willing sellers. And to showcase how institutions normally act in the market, I will share, of course, our famous Warren Buffett case study. And this case study, what it does, it really captures the essence of how institutions act in the marketplace. If you know this case study already, I still want you to stay tuned in, because I'll also introduce another fundamental setup tool today, Campus Valuation, as I believe it goes hand in glove with this specific case study. Keep in mind that this is the last concept lesson. It's the last 101 lesson. So the last of Strategy 101. And after this lesson, you'll have the knowledge and the right foundation to go to module 2, where we will start building clear mechanic and objective rules around the concepts you've already learned, and even some additional concepts that we will introduce. At this stage, most of you already know how to read price charts from the previous lesson. And so what you see in front of you, this is a daily price chart, and it could be a daily price chart for any market. Which market this is, I will reveal later on, but it's not so important for now. What we want to do is a little bit of an experiment here, or a back test. Back testing is an exercise that is part of the study of the past. Remember, we predict the future based on the study of the past. So back testing will be a crucial exercise for you to do for the rest of your trading career. So that is just what we do, right? Back testing and predicting the future based on the past. So let us quickly talk about this chart right here. And let me open up this case study by posing a question that I want each of you to answer. If you can visually write in this chart using your annotate tools, what would you say were the absolute best times you could have bought into this market right here, regardless of what this market is? When are the best times in the past you should have bought this specific market? Daniel, picking the low. All right. Anyone else wants to take a stab? Daniel, again, yes. Picking another low. Yes. Ashita, yes. Perfect. What's quite interesting here is that most of you were pointing out the lows of the chart, right? And so you are on the right track here. And that just makes sense because the lower we buy, the cheaper we buy, right? And the more profit margin we have as a result, as price is moving up or as price is rallying higher. What do we also know about these areas of price, these lows, in terms of the relationship of the willing buyers and the willing sellers? Or in other words, what do we know about these areas in terms of the relationship between supply and demand? Well, what we know is that there were tremendously more willing buyers than willing sellers, more demand than supply. Okay, so if it is more willing buyers at these areas, and we know that only institutions have the liquidity or the buying power to drive price, then it must have been not just any willing buyers, it must have been institutional willing buyers that came in from down there that drove price up. What you can see on this slide is an article by the CNBC about Warren Buffett that explains away why he bought 10.7 billion US dollars worth of IBM stock. And this article is dated from November 2011. And in short, it tells that Warren Buffett has been buying IBM shares worth of 10.7 billion US dollars since March 2011 and apparently continued to do so. This article is from November 2011, and it says that Buffett has been buying since March 2011. So Buffett had pretty much been trying to buy and accumulate more stock for the entire year of 2011. Or in other words, Warren Buffett had been a willing buyer of IBM shares in the year of 2011 since March, to be exact. Now, the goal of an institution like Warren Buffett is to ideally fill all their orders and ideally at a favorable price. What we can see is that the area that some of you picked right here is representing March of 2011. And in fact, this is representing the IBM chart from February to November 2011. So right here, you're dated in March 2011. Warren Buffett started to buy roughly around this period of time. The area you guys spotted is actually the area where Warren Buffett started to buy IBM stock. So let's turn back time and let's try to put ourselves in the shoes of Warren Buffett for a second. And after, we would then try to argue how we could act as a participant here as well. So let's assume it's March 2011. There's one really important question that we must ask first as we look to buy IBM shares worth of 10.7 billion US dollars. How many shares can we buy? Well, that's kind of easy math, right? Let's say we're buying at $160 per share because that's the share price of beginning of March. So buying 10.7 billion US dollars worth of IBM shares with an average price of roughly, as we said, $160 per share, we can buy 67 million shares of IBM. 67 million shares of IBM with an average price of around $160 per share. That is a lot of shares. So what we do next is let's put this into context of the market in specific. Let's put this into context of IBM. So if we want to buy 67 million shares as cheap or as low as possible, then can we buy all those 67 million shares, or can we accumulate all these 67 million shares of IBM all in one day? Well, if we look at the average daily volume here that had been traded on IBM in 2011, it was roughly 6 million shares per day. You can see that right here, 90-day average daily volume, roughly 6 million. However, we're trying to fill 67 million shares of IBM. So the answer here is pretty obvious. We are trying to accumulate a lot more shares than this market can digest in one day. And based upon the laws of supply and demand, the relationship of willing buyers and willing sellers, if we were to place an order of 67 million shares all in one day to buy that stock, then what would you guess would happen to price of that stock? Well, the willing sellers would be canceled out completely. And as a result, price would skyrocket. And it wouldn't just skyrocket a little, it would rally a lot. And we would get maybe a small percentage of our orders filled, and then the stock would end up moving higher and higher and higher. And as a result, the IBM shares would become more and more expensive. So that means in turn that if Warren Buffett buys a little bit, and as a result, price is rallying up, and if he then was to chase price on the way up, then he would continuously buy a majority of the shares at a much higher price. And this would be really bad for Warren, right? It's bad because buying higher would drive up also the average price per share that he could buy as a result. So likely he will not act that way. Likely he will not chase price up higher. Remember, the entire goal for institutions is to buy low and sell high. So they are likely not buying high. What he's more likely to do, due to his desires to make good returns on all of his investments, is that he will patiently wait for low prices to get all of his orders filled. So if you're Warren Buffett, your goal is to get 67 million shares filled with disrupting the price as little as possible. Okay, so how can he do that? Well, only in scaling in. So he will scale in over time. And in this case, it took him almost a full year to get all his willing buy orders filled at a desirable or favorable price. So after all, this article, if you remember, it was only released in November. So at this stage, very likely is that he had managed to fill all his orders. Otherwise, it would also be unlikely that he informs the general public about him being a willing buyer, right? If he's trying to get as many of his orders filled, then he doesn't really want competition in doing so. So it took him close to a full year to fill all his orders. But from March onwards, he started to be an institutional willing buyer. Okay. And that's the point. Him being a willing buyer means that there must be a price point where his unfilled orders are waiting to be filled. Okay. Not physically necessarily, not in the order book, because he will not leave it in the order book for others to see, but they're hidden unfilled orders that are waiting to be filled because he would be a willing buyer at a certain price point. So in other words, there must be a price area here at which Warren is a willing buyer. And these price areas are the areas we want to identify using supply and demand, and identifying by looking at price and the price charts. So the areas where demand exceeds supply and price just skyrockets, These are the areas where there are likely still unfilled orders to be found, right? So we can see in March, price declined a little bit, and then price really just skyrocketed. And then price declined a bit, and then price really just skyrocketed. And then price came back in, and then price really just skyrocketed. So we'll do a little bit of a practical application here in a bit, but let's just capture what we learned about how institutional participants act so far. So number one, can institutions buy everything they want to buy all at one moment in time or in one day? Yes or no? Well, based on what we just discovered, no. They have to buy a little bit here, right? And then they have to buy a little bit later. And then they have to buy a little bit later again until they've all their orders filled. So if you're following that thought process, it's really important to understand. Institutional participants really of all sizes, and Warren Buffett would be considered a smaller institutional participant. They scale in over time. They cannot buy all at once. Their goal is to fill all their orders at a favorable price though. So this is the pickle that they are in. What about us though? On the other side of the coin, well, our advantage is that we can buy all at one time. We may not be able to move the markets, but we can easily get in and out of the markets and fill all our orders at any time, at any price. So let us actually drive this concept now home by spending some time in the real charts rather than in the PowerPoints. What you can see right here, I'm in the year of 2011, and this chart is starting from February, and it's going all the way to December of 2011. In March, do we know that Warren Buffett or any other institution is buying here? No, we do not. But we can see institutional footprints in the price chart after the fact that they have bought. And knowing that institutions scale in over time to get all their willing buy orders filled, we would simply look for those institutional footprints in the chart. So how do we see that an institution acted in the market? Well, we really saw that price took off from here all the way to here. We also saw that price took off from here all the way to here. And we also see that price took off from here all the way to here. So by looking at price only and checking where price really took off, where there are likely to be institutions, we could potentially identify areas of imbalances within the chart. Now, how exactly we will draw those areas, you are yet to find out, right? But what we can say is that if we're looking for the origin of any imbalance, then we would be looking at, okay, at which point do the candles really turn green? And at which point where's the origin of all of this rally, right? Where's the origin? So the origin is where the green candle starts. Let's just keep it at that. Okay, let's just keep it very simple. And therefore, we could put and wrap some lines around these levels. And we could say we have an entry. And we could say we have a stop right there. And what we then do is we also put a yellow box around it. And we call this area demand. Okay, this is the first area of demand that we could have potentially spotted in this market. Back in March, we know nothing. Well, here at this point in May, after this rally had taken place, we know that something happened here. We know there was an imbalance. There was a lot more willing buyers, and there must have been institutional willing buyers because they're the only one that can really drive up price that high. We don't know whether that's Warren Buffett, whether that's BlackRock, or whether that's a multiple of institutions that are buying down here for the moment, right? We only saw this within the article in November. And in November, if you're reading the article and we're buying in November, then we're a little too late to the party here. So we need to know this in advance, right? We cannot wait for the news to come out and explain why this rally has happened. Well, because Warren Buffett bought, duh. So supply and demand will help us in identifying basically where those institutions have created supply and demand imbalances in the past, and therefore it will show us areas of price where it is likely that institutions are continuing to be willing buyers or sellers. So in this case, we're arguing to buy right at the origin of this demand area. So this here's where our entry would be. And then, of course, we would also have a stop loss. So now we just have to patiently wait for price to come back inside our entry. And at this point, we would be filled. We would have a stop loss. And then we could ride this big wave created by institutions. So again, by looking at price only, we have no idea that somebody was buying in March. But from May onwards, definitely July and August, we could identify this area as demand. And we could look to buy this when price is coming back. That is very clear so far. So that way we would align ourselves conceptually with smart money just by looking at price. So what we've established is that institutions, they control price of the markets we trade. They drive them up, they drive them down. And why do they do that, or why can they do that? Well, because they are trying to fill all their orders. Okay, and they're trying to fill mostly more orders than any market can digest at one day. And therefore, they are the ones that create imbalances. So we can't move the price of these markets, and that's fine. We just want a piece of their cake by aligning our positions with theirs. And this is then how we would place our entry stops and targets accordingly. Once we identify a supply and demand imbalance where either willing buyers or willing sellers have become zero, we would go in and then we would look to place our entries. We would look to place our stops around those imbalances. And what we're doing though, right, is we're just looking at price. So we're looking at market timing strategy. So we're placing a set. How do we know though that the fundamentals are still bullish? Because what we sure do not know for certain prior to this article release in November is that Warren Buffett was buying. Okay, so let me show you using another fundamental forecasting tool, okay, that we'll spend a lot of time on in the future. That's the Campus Valuation tool. Let me just add that right here. And so let me just talk a little bit about the Campus Valuation tool here. So Campus Valuation can tell us when an infinite market is over or undervalued. So infinite markets are markets like stocks or equity indices, right? And value in stocks is usually measured with PE ratios and or interest rates. So you're probably wondering, okay, what is this based on? How does this work? So let me explain. Okay, and generally we all want value for money, but what is value? Okay, and how can we get a sense of value for all sorts of stocks and equity indices? What we're going to do is we're going to look at the relationship of any specific stock, okay, and we're going to look at the relationship of that specific stock compared to interest rates. And what usually happens is, that's a really interesting phenomenon, is that there's usually a specific spread in terms of how close together or far apart these are, the interest rates, treasury markets in specific, the 30-year treasury bonds, and these specific stocks. And so I believe that interest rates have an extreme influence on the prices of stocks. So therefore, what we want to do is we want to compare the price of stocks on a ratio to interest rates. And this would then give us either relatively low readings. You can see that right here within the chart right here. Whenever we go below the green line, we would be undervalued. And or whenever we go above the red line, we would be overvalued, fundamentally speaking. So if we now take a look at how this all interplays with price, right? So the last time, so the article was released in November, right here. Okay, at this point, we are overvalued. Okay, so the blue line is above the red line, so we are overvalued. Okay, but let's start in March, because we know that from March onwards, Warren Buffett was buying. So in terms of just looking at price, we don't really know in advance that someone as big is buying here, right? But if we had looked at fundamentals, then we could argue, well, price is undervalued. Okay, that is not a timing tool, it's a setup tool. And so from here onwards, all the way to here, we stay consistently undervalued. So green and green. So here we're undervalued. Hence, very likely institutions are going to come in here, because institutions perceive this as cheap, and they will drive price higher. And so they did. After that, we can see that there's demand formed within those areas of undervalued readings. And then after a while, price comes back again into an undervalued reading. Okay, here maybe potentially a little bit early, right? Just the same as here, a little bit early. But what eventually happened to this undervalued reading is that eventually we saw another rally in price. And do you see how all these major rallies that we saw in all of 2011, all had a precursor, and the precursor was they were all undervalued compared to the treasury bond market, compared to interest rates. Okay, so just stay with me for now. We are going to discuss this in a lot of detail at a much later date, but just conceptually speaking now, we have another time where again we're undervalued, right? We're again below the green line from here all the way to here. And eventually we get another big rally here. Okay, so these undervalued readings, they are what we would call a fundamental setup in this market for specifically our infinite markets. And when we find demand, when we find a good entry and a good stop loss in the market, when price comes back, what we want to ensure is that as price comes back in demand, what's also happening is that we're undervalued at the same time. And as a result, we would ensure that, yes, there are still unfilled orders left. Or in other words, yes, there are still potentially willing buyers left at this area, because again, we're undervalued against treasuries, right? And in fact, all of those areas where we had been undervalued, whether you're looking at this area or whether you're looking at all of this area, they all have one thing in common, or whether you're looking at all of this area, they have one thing in common. They produced the major rallies. They were the precursor of those major rallies that we saw within IBM in 2011. So if you are now a technician and you have a little bit of, let's say, chart and indicator experience, and things like overbought and oversold technical indicators, they sound familiar to you, then let me just cover the following. And this is really important because what you're seeing here is not a technical indicator. Okay, it is an oscillator. Okay, an oscillator means that we put something into an index, and if we put something into an index, we automatically look at price. However, we do not look at price only. What most technical indicators do is they look at price only, and as they look at price only, they would argue oversold and overbought readings. So for example, stochastic. And that would purely be based on price action. The problem of those indicators, technical indicators, is that during times of extreme bull markets, like here, for example, it would show overbought most of the time, and there would just be no area of entry, and the overbought areas are just way too quick, and then they diminish, and then we go to overbought. And during times of extreme bearish markets, it would show oversold most of the time. And so I could just quickly show the difference here as well. What you see now is an indicator that's just based on price action. So you see an oscillator, stochastic, that's just based on price itself. Okay, and so what you will see is, of course, as price is going lower, also a stochastic will show you an oversold reading, which in this case, it would tell you that you would have to buy. But and here potentially also a little bit early, just as us, but notice when this right here is going to overbought, and down here we're still pretty much undervalued, right? So you see the difference. We're undervalued. We should still be buying. However, here we would be already, overbought, and we could not buy anymore. We would actually do the difference. We would predict a decline, and then we stay overbought for ages, and so we're only turning somewhat overvalued here, and that then creates a little bit of a decline in the markets. And then again, here, this is a little bit early here again, but then we turn undervalued. But the problem again is, as we stay up undervalued here, right? So we're looking to buy. Okay, we're looking to buy. Both of us were right. We're looking to buy. But then all of a sudden, this is like, okay, we're now overbought. We shouldn't be looking to buy anymore. We should be looking to sell. And then guess what? We're still undervalued, right? And we're not overvalued until here, right? We're not overvalued until here. And then what happens here is price then starts to decline, and so on and so forth. So you can really see the difference between the tool that we have, which is a fundamental setup tool, as we also look at the relationship of the price of the stock, right? So yes, we do look at the price of the stock, and if the price is declining, we are also likely getting undervalued. But we're not just looking at the price of the stock, we're also looking at the relationship of the treasury bond market and interest rates as a result of it. And in specific, we're looking at the spread of how tight, of how close together or far apart those two markets here, IBM and the US Treasury markets are moving. So it's a very different way of analyzing. And if you're not familiar with other technical indicators like this one, don't worry about it. If you are, then you now see that there's actually quite a big difference here in those two. So let's sum up once more. In March, we know nothing. We know we're undervalued, but we don't have demand yet, right? We don't have demand yet. And then we see all of a sudden that demand is being formed. And now within that imbalance, as we see that, we can place our entries and our stop losses around those price levels. Okay, as we look at price, this is our market timing technical strategy based on price. And as price comes back, as we're undervalued, we can assume that, hey, here are still unfilled orders, there's still willing buyers left, and they must be institutional, because the only participant that can drive price this much higher must be an institution. And how likely is it that there is an institution? Well, there's very likely that there's still institutions left, because we're undervalued, fundamentally speaking, in terms of looking at our valuation tool. And so therefore, all this time, right, is all this area is a buy area, and then we would be filled here, and we could be riding the wave on the way up. Now let's talk quickly, and let's take a look quickly at the other side of the coin, and let's look at supply. And so this article right here was released in May 2017, so roughly 6 years later. And it says that Warren Buffett has now sold IBM shares and revalued the tech icon downward. And so this article basically summarizes how Warren Buffett sold a third of his shares in Q1 and Q2 2017, so from January up until June. So Warren Buffett sold a third of his shares of IBM, and as a result, what he creates is a massive imbalance in the market. As you can see, price really declining thereafter from the beginning of the year. And so as price is declining, what Warren Buffett wouldn't do, right, because he still has 2/3 of his orders still left, 2/3 of his portfolio is still there. What he's not going to do, he's probably not going to panic sell his shares as price is declining. Rather, he's going to wait for price to come back to retail. So he would be again a willing seller at these price levels of roughly $170 per share. At this area, he would be a willing seller. Okay, at this area, he would be again a willing seller, or in other words, there are likely to be unfilled orders of Warren Buffett. So we can now say with high probability that there may be hidden, right, unfilled orders left here, and more willing sellers than willing buyers equals an imbalance, in this case, a supply zone. Now, here's the $1 million question. If price is going to come back up to the $170 per share area, would you want to buy IBM, or would you want to be a seller of IBM? Well, you'd probably want to be a seller, right? So let's move forward in time. And this article is about Warren Buffett and IBM again, and it summarizes that Warren Buffett has now sold his remaining shares in Q1 2018. And what we can beautifully see is that the imbalance that was created as price comes back into the origin of that imbalance, there's still 2/3 of his positions left. And as price comes in, more orders are being filled. And that's what has to drive price lower in 2018. Now, important to note, of course, here is that I'm showing you news that explain away why, of course, something has happened in the past. But what we will be able to do, and what I'll show you, is to spot those institutional imbalances in the price charts, and to ensure that we follow the big guys. Why I'm showing you the news as well is to really paint a better picture for this case study in specific. So usually here's what happens first. And an institutional willing seller creates a supply imbalance. And as a result, we can then spot the supply area, right, in yellow where it says supply. And here we would argue that there are still a lot of sell orders to be present. And then when price comes back into this area, the remaining unfilled orders are likely to be filled and price is shooting to the downside as a result. Again, how could we participate here? Well, we don't know that Warren Buffett is, again, we don't know that he's selling back in April. We don't know that he's specifically selling in Q1 2018. But we know that in Q1 and Q2 2017, there has been a supply imbalance that formed within the price chart. And we could spot that in form of a supply area. And so what we then do is we place our entries right here, and our stop losses right here, and we place our set around our supply zone, which means that if price comes back, we would look to sell and therefore align ourselves with institutional participants right here, whoever they may be. Okay, so starting with the next module, we're going to go into a lot of detail on the process on how to identify these areas with high probability. And so basically translating the laws of supply and demand and unfilled orders to these price charts that we look at, that we'll look at day in and day out. So let us summarize some of the key takeaways here really, really quickly. Who controls the market? It's institutions. Can institutions buy all at once? No, they cannot. They clearly must scale in over time, and they require multiple transactions. Can we buy all at once? Us, the small trader? Absolutely, right? That's our advantage. We're very fast in the marketplace, although nobody cares what we're doing. That's also good. And that's really our advantage. We can be super quick and smooth participants in the marketplace. Bottom line is, if institutions are buying, you better be buying as well, right? And if institutions are selling, you better be what? Selling as well. Okay. How do you know where they're buying and how do you know where they're selling in terms of price? Well, when they act, we can spot institutional footprints. We can spot major imbalances in the markets, in the price charts. They create large supply and demand imbalances that lead to big rallies and that lead to big declines in the market. And once we identify those imbalances, we then place our entries and stops around those, as we know there are likely still willing buyers or sellers left at and around those price areas. Now, what's very important, I want you to write this down on top. Okay, so the more bullish the fundamentals, the more likely it is to find more willing buyers in demand. Okay, so again, the more bullish the fundamentals, the more likely it is to find more willing buyers in demand. And the more bearish the fundamentals, the more likely it is to find more willing sellers in supply. What we want to do is, just like you saw in IBM, we want to buy in demand when we see a good fundamental setup. In this case, we were perfectly undervalued for long times, which would give us the license to then predict major rallies into the future. So again, we're predicting an A to B with our fundamentals, and we're then going into the price charts and we are timing this by looking at supply and demand and placing our entries around and stop losses, our sets around those supply and demand imbalances. So there are still some things that I would like to cover, okay, before we go into really creating a process and a rule book for you and we form some clear and objective and mechanic rules around all these strategies and sub strategies that I'm kind of covering the surface on at the moment. And this is though the last part of today. Okay, so we're going to speak a little bit about economics, and then we're going to speak a little bit about how economics translates into the charts, and also about some of the retailer misconceptions about the markets and some beginner mistakes that I just want to get out of the way before we then go into the nitty gritty, really rubber meets the road rule set and rule book. So if you remember your economic lessons back in school or back in university, that may be a very long time ago. At least for me, it's a very long time ago. But if you still remember it, then this part is going to be really easy for you to grasp. If you do not, then just hang on with me. Okay, I'll just explain a little bit about how economics really can be translated into the price charts, because we're always speaking about supply and demand and imbalances. So that supply, what we really speak about when we speak about supply and demand is order flow, but also how the theories of, let's say, textbook economics 101 would translate into our price charts is quite interesting as well. There is a key takeaway at the end, which I want you guys to really understand, and which will be important going forward when we talk about the analysis of supply and demand and how we translate that into the price charts. And so we've all seen those two curves here before on the left, and we see a supply curve, and on the right we see a demand curve, of course. And now, how do you read these curves? Well, on the supply side, you would say the higher the price, the higher the supply. And on the demand side, the higher the price, the lower the demand. Okay, so to summarize here, we can state that supply increases the higher the price travels, and that the demand increases the lower the price travels. Okay, those are laws of price. What we want to do is we want to buy low in demand and we want to sell high in supply generally, right? So far so good. So if we're now matching the supply and the demand curve in one chart, we're going to get three key areas here in this chart. We have a market balance or a market equilibrium. We have an area of supply excess, and we have an area of demand excess. The higher we go from market balance, the more supply excess there will be. The lower you go from market balance, the more demand excess there'll be. So the kind of key takeaway here is, and almost like a rule that I want you to understand, I want you to write down, is that when price is at market balance or when price is at equilibrium, we want to be neutral, okay? Because market is balanced. Remember, we want to participate not when market is balanced, we want to participate when market is in an imbalance. So if price is in supply, then we want to be a seller. So we want to be a seller because we can assume with high probability and high profitability that there are more willing sellers than willing buyers. Okay. If we are predicting price to move lower, we need to sell where there are institutional willing sellers. In other words, we need to sell where there are institutional unfilled sell orders, and that is going to be in supply excess or in supply zones. So on the other side, if price is in demand or in demand excess, if there's demand excess, then we want to be a buyer. Okay, so why do we want to be a buyer? We want to be a buyer because we can assume with high probability and high profitability that there are more willing buyers than willing sellers. And if we are predicting price to move higher, we need to buy where there are institutional willing buyers. In other words, we need to buy where there are institutional unfilled buy orders. So just a little bit of a summary here. in terms of the market concept and economics 101, and a little bit about the previous lesson as well. So market prices turn where supply and demand are out of balance, okay, meaning one party becomes zero at a specific price area. And that's always called supply or demand. Therefore, we as a trader, we must identify in advance those supply and demand areas in the price chart. Now, the Warren Buffett case study showed a clear demand area and it showed a clear supply area for IBM. And these areas of imbalances was where we could find unfilled orders from institutions. And as a result, and as a rule of thumb, you could say, the greater the imbalance, the higher the amount of unfilled orders. But the better, the more favorable the fundamentals, the more unfilled orders you will find in those imbalances. So when analyzing price charts or when looking at technicals, our goal is to find the institutional unfilled orders. That's always our goal. And why do we do that? We do that to set our trade parameters, to place the entry, to place the stop, to place the target. And as a result, if the fundamentals are backing us up, then we try to ride big waves created by big institutions. What we can see here from left to right is just candles, right? And it seems like prices in balance, right? There's nothing happening here, neutral price action. And then all of a sudden, price declined and price declined heavily. So what happened here is there must have been more willing sellers that canceled out the willing buyers. So the willing buyers were zero at this stage. And right where the origin of this imbalance was is where we see supply or retail prices. So what we're going to do is, since we know that it's very likely that it was institutions that created this imbalance, that it's likely that they are going to be willing sellers again at this area. So if then price comes back in, we are going to be a seller here as well. Vice versa, if we're going to look at this here again, price is kind of neutral, right? Not going anywhere. And then all of a sudden we see a big spike, a lot of green candles in this market. So why did price rise here? Well, it must be that there are a lot more willing buyers than willing sellers. And the willing buyers, they've canceled out the willing sellers. So the willing sellers have become zero. And the only participant who is potentially able to do that are institutions. We know that institutions have to scale in over time. They're likely not to buy or sell all their orders all in one day or a couple of days even. So they need to patiently wait until price comes back into their price areas to then scale in to buy again. So be willing buyers left here potentially at this area. So if price is coming back, we are then going to go in and look to buy where there is demand. Okay, so first we're spotting this imbalance, then we place an entry here and we move that entry to the right. And then we put a stop loss just above. And as price comes in to this area, we would then be in this price and we would be predicting declining prices. Vice versa, right here, after this rally in price, we would be seeing some imbalance in the market and we would be placing our entry right here. We would be placing a stop loss right here. And as price comes into this market, again, we would be predicting a rally to the upside and our orders would get filled here. And if price rallies, we would then collect reward as a result. Now, what's going to happen most of the time is that someone is on the other side of the trade, right? And we already saw from the Commitment of Traders report net report example from last week, the last lesson, that the retailers usually do the wrong thing at the wrong time. Okay, so we quantified already what supply and demand looks like on the chart and in the market, just conceptually, right? These big imbalances, these big rallies or declines. But let's also figure out quickly who's usually on the other side of our trade, because we want to identify these people, because what we really want to do is we want to avoid them like the plague. Okay. And we don't just want to avoid them. If we can figure out what they're doing, then we can almost do the opposite of what they're doing. Let's think about Walmart, okay, for a second. One of the biggest retailers in the world. What are the two things that Walmart needs? How do they make so much money? After all, they don't really produce anything, right? They're just the middleman between us and the product. So what are the two things they need to master? Well, number one is they need to be able to master the science of buying in wholesale prices and selling in retail prices. The second thing they need to be good at, really good at, is getting people to come into their stores. So those two things go hand in glove. Okay, so let's deal with that. Step number 2 here. When people come into the market, we want to know exactly who we're selling to and who we're buying from. Okay, it needs to be the same group of people every single time. So if we focus on this upper area, right, on the supply area right here, then you're getting people that are buying after a rally of price. And yes, of course, it's a lot easier to buy into rallying prices. They do 2 mistakes here. Mistake number 1 is they buy into rallying prices, and number 2 is they buy right into supply as well, right, where we see potentially more willing sellers than willing buyers, so price has to decline. Now, who is going to sell down here? Because wherever price goes within the chart, you always have transactions taking place. So there's always someone on the other side, right? If there's no one there on the other side, you would not have price going there. And so who is selling down here if we know that there's demand? Well, it's mostly panic selling. It's, again, the novice that is selling after a decline in price. Mistake number 1. And the person who's selling not just after decline, but also while price is in a level of demand where we know willing buyers are potentially exceeding willing sellers. And as a result of it, we should see a rally in price. What's to note here is that it's always, right, and there will be a lot of hardwiring that's needed to get away from herd thinking or panic selling mentality, right? So usually we don't buy with and after rallying prices, okay? And we would not sell after price declines. We would actually do quite the contrary. And that can feel quite difficult in the beginning, right? You're buying into declining prices. That means you're doing, if it feels strange, then at least you're doing something right, right? And trading in the beginning, it should feel strange, right? We should be a little bit scared. What, price is declining, it's dropping, and now we're buying? It should feel counterintuitive, because the intuitive thing is, what we're hardwired to do is to buy into big rallies and to decline into big drops. However, that's not how you'll increase your success in the market. So this slide right here may be powerful for those of you that have a little bit of trading experience or have read some trading books or some, YouTube tutorials that talk about support and resistance. If you haven't, then even better, right? If you've never heard of support and resistance, then even better. But let me just go through this slide and this example to paint a picture for you. So right now, what we know is we can see price rallying, basing, then it's dropping. We see a large decline. And as a result, we would say, well, where's the origin of this imbalance? It's somewhere here, right? That's where the red candles start. And so that's the origin of the imbalance. And then we would argue, well, potentially there's going to be some unfilled orders left here. Now, with these unfilled orders, we don't really know how many there are, but let's just put a number for it onto it. All right, let's just say there's going to be 9,000 unfilled orders left at this area, so that when price comes back into this area, we could say, well, some of these orders are now being filled, and in the filling process, transactions that are taking place, we would see that the loss of price and price flow, that price then declines out of this area. And as a result, if you now think about this number of 9,000, it could be any number, but let's just think about this number 9,000. What now should happen to this number is, because these orders are being filled, it should be less, right? So how much less? We don't really know, but for sure it's going to be less than before. And so again, if price comes in again another time, what again happens? Well, if we see a reaction here again, orders are being filled and there's potentially less unfilled orders left, or less willing sellers left at this area. And eventually what's going to have to happen is that there's no willing sellers left anymore. There are no unfilled orders left anymore. And price spikes through this area and rallies above it. Now, the concept of supply and demand is that with every retracement into our zone, okay, that's very, very important. That's the first retracement into the zone. That's the second retracement into the zone. That with every retracement into the zone, we're likely to see less unfilled orders as a result of each retracement, until there's no unfilled orders left and price is spiking above that. That is the laws of supply and demand, and also the laws of price flow. Okay. However, if you're going to look at support and resistance, what they would argue, if they were to argue a strong sell zone, right, then they would say, well, at this point, if they saw this, they would say that's strong. Okay. So at this point, they would say, oof, that's stronger, right? And now, after even being a third time there, it would be the strongest, right? So support and resistance is arguing it the other way around. They say the more you see reactions, the stronger this is. And it's kind of counterintuitive, right? Because we know that the more time price is touching an imbalance, the more orders are being filled, hence the less orders there are. And saying that you want to sell here would be counterintuitive looking at supply and demand, but support and resistance is what, as per the textbook, would tell you to do that. So what's quite interesting, or what's important to say, is that it's really supply that's creating a strong resistance area, right? And once a strong resistance area is created and price is coming in a second time, we are already likely saying, well, this is not for us anymore, right? We are likely to stay away from this, as we're only going to, as we want the best and the highest odds of the most unfilled orders left. And that is from the get-go, right? From the start. Right here is when we have the most orders left. And right here is when the support and resistance trader will say, well, great, let's look to sell this. And up here is where we're now going to say, well, we're not going to touch this anymore. And definitely not another time, because eventually we know that price is going to go above. So demand creates support and supply causes resistance. So that concept is important because later on I'll cover something that is called trap areas, and trap areas are going to look to trap those conventional support and resistance traders by looking at supply and demand areas right above or below support and resistance. So just if you're like, yeah, I don't know, I've never heard of support and resistance, I don't need it. Yes, you will, right? We will learn about it, not necessarily because we want to use it. Well, we do use it, but we don't want to trade it. We want to use it in a way to do the opposite and therefore enhance our odds of success, if that makes sense. Okay, so still an interesting concept slide, especially if you are familiar with support and resistance. So lastly, as you know, my goal in this course is to give you all advanced tools and knowledge about the markets that we trade. Okay, so we can make, or you can make, sound financial decisions and choices for your future. And so I want to give you access to these powerful and well-seasoned forecasting tools and technical strategies like supply and demand. So moving forward, I will introduce a lot of rules, okay, that are objective at first, and they are black and white. And they have to be objective and they have to be black and white in the beginning to train your eyes to look at certain things and to train your eyes to identify certain things in the markets that we love to trade. However, the more advanced you will become, okay, the more gray some of the rules that I will introduce as black and white may become. Okay, why? Because, well, the reality of the financial markets is that they are not black and white. Okay, and barely anything is black and white. Okay, your life is not black and white, and your job is not black and white. And yet, everyone that comes to me and comes to us that wants to learn trading, they all want trading to be like math. They want it to be 1 + 1 = 2. But when we apply math to the world of trading, 1 + 1 may be 2, yes, but it's not always 2. It's not an absolute. Okay, so rather what all these strategies do, and the forecasting strategies and the market timing strategies, fundamentals and technicals, what it does is it gives us more clarity, okay, or a better perspective or a roadmap on the imperfect markets that we trade every day. So by now, more than thousands of hours of mentoring, individually, one-to-one mentoring students, campus students. Some of them, I can say, they have really excelled and they have probably even become better traders than I am. I'm humbled to say that. But I have personally also learned a lot about all the different mindsets of beginners in trading. And what I want to share with you are some of the most troublesome mindsets to me. Okay, so you can attack those straight from the get-go if you don't have a mentoring with anyone or you don't have individual one-to-one sessions with me. So what I call this group of people, I call them alien traders. So let me explain here. The alien trader has the desire or the hope that there's some sort of perfect and fully automated trading system, that some place somewhere on the moon there is utter perfection and structure and order to the markets. The issue here is that the more perfectionist trades you have, okay, the more you will struggle with the markets. I know this because I was kind of like that in the beginning. I really struggled with the markets. So the markets, they are imperfect. They are not perfect. What we have to make sense of, we have to make sense of an imperfect world. Okay. And so the alien trader believes that there is reason basically for every market move, for every high, for every low, every move of price must be totally predictable and totally explainable. And to this, I can only say that the more time you spend in outer space or with this group of people that share those beliefs, the worse your trading will be. Okay, so you read all these news that will explain away why a certain market has moved today and why something has happened, and explains away the past. The smart observation here is that they only come up with all these reasonings after the move had already happened. So too bad we cannot invest into the past, isn't it? It's like, as I like to say, hindsight is 2020. So the best traders that I know, they walk on this planet. Okay. They're the ones that know that markets are imperfect and they're not always predictable. Okay. Markets will be random and markets will do things that we cannot explain. And perhaps you'll be able to explain it afterwards to learn maybe a little bit about the markets we trade as we move forward. But there are cases where we cannot explain away why something has happened, or we cannot predict major moves all the time, meaning we will miss one or the other market move. And I always say we cannot be part of every party, right? But we must focus on what we can control and what we can predict. So this golden rule here will allow you to stay humble, even if you feel you have all odds in your favor, and even if you feel that it's all so easy and that you're on a bit of a winning streak. And these are just some key concerns that I just wanted to share with you all, since I do not have one-to-one time with all of you necessarily individually. And as I talk about it, hopefully I can at least steer the mental game already from day 4 right into the right direction, as you now from next week onwards are going to approach these new strategies that I will introduce in the coming weeks. So I hope to have given you a better understanding of the key concepts and strategies that you'll be following, okay, from now onwards. Now what I can do is I can give you the keys to enter the next modules, and we'll start the next module next week. And what we will do during this next module is we'll start creating a rule book that will guide you for the rest of your trading journey. Okay, so sharpen your pencils, everyone, for the next lesson. Until then, thanks for watching. Happy and safe trading. And I'll catch you all for sure next week and or during my live trading sessions. I'll now stop the recording. Feel free to hang around, and it's time to ask some questions if you have any. Thanks again, and ciao.